Meanwhile, we'll play one audio video clip.
Sure, Krishan.
You can start, Yogesh.
Yeah. So it's 10:30.
And for the
Yeah, it's
good morning,
10:30.
all the Pentagraph family members.
Good morning.
I
Good morning,
thank
sir.
the management of Pentagraph to give me this opportunity to speak on a topic which is very close.
It's 10:35. We can start now. So good morning, everybody. Welcome to today's Pentagraph Knowledge Series. I'm Yogesh Mehta, Senior Director with Pentagraph Partners. I'm hosting today's event. Let me share with you all what is the objective of these monthly knowledge series. Creating wealth or achieving financial freedoms. It's like a farming, wherein not only sowing a seed, but also removing weeds are equally important. Hence, every month we get an out-of-town expert who can help you to understand or decode news versus noise so that you can stay put on your financial journey peacefully. Without much ado, let me introduce today's speaker. Sharma sir, designated as a Deputy Vice President and National Lead, training at HDFC AMC Limited. He is a graduate in Economics Honors and a postgraduate in Management Accounting. He has been in mutual fund industry for over 26 years. Before joining HDFC AMC, he had worked in various positions in research, PMS, and institutional businesses. While working in many parts of country, he has undertaken extensive training programs, investor awareness programs for all segments of business across India. Till date, he has addressed more than 1,500 investment seminars and training sessions covering over 150 cities in the country and abroad. He has been held as one of the best trainers and speaker in the industry. Allow me to add further, I'm the one of the beneficiary of his sessions. And I'm sure post presentation, you will experience the same. I request all participants to put your queries or questions in a chat box so that we can address all of them post presentation. Over to Krishan Sharma, sir.
Thank you. Thank you, Yogesh. Thank you, Pentagraph, for this wonderful opportunity and to connect with you, so many good friends from Pentagraph. So, friends, as Yogesh has just said, our aim is to create wealth and achieve financial freedom. Financial freedom is the most wonderful thing in life. It's most of the philosophers are of the view, psychologists are of the view that we enjoy our life if we feel free, right? So we should have the biggest aim of the life should be achieving financial freedom as soon as possible. But friends, you must have noticed something very interesting. I accept that it's difficult for anyone to do businesses. All of us are not of entrepreneur metal, right? Very few among us can be very successful businessmen. But we all know that the all successful businesses, the largest of businesses are listed in the various markets, stock markets. The largest of US firms are listed in US markets. The biggest and most successful businessmen have listed their businesses in Indian stock markets. And we have seen that Indian stock markets have delivered you upwards of 15-16% CAGR return, which is 3 times the return of returns what you get in deposits. And on the top of it, you have a tax efficiency. Then how come when stock markets give you such a wonderful opportunity to create wealth, and markets have created wealth, we have evidence, we have index which shows that, why so many people create wealth? And that's an issue, right? We want to create wealth, there is an opportunity, there is an evidence, and there's a way that we can achieve. And why so few of among us, those who are investors, have created wealth in India, not in India, anywhere in the world in the past few years. That's something very interesting topic, friends, we need to discuss. Yogesh, let me submit one thing very simple. We are not in a great number, so it will be very good if you make it interactive, right? So you can stop me anywhere, right? And we can discuss on the subject, because the subject we are discussing is not science. There is nothing right here and nothing wrong here. There's only perspectives and how you look at things, right? And how you respond, how to react to a given thing is very important here. So I invite each one of you, every one of you, to make it interactive, share your questions, share your perspectives, and you can stop me anywhere. I will start this discussion with a simple question. And the question is, you can write your answer in chat box, and Yogesh, you can help me out what the answers are. Currently, we are going through a war between Russia and Ukraine. Perhaps we are more than 55, 57 days now, closing almost 2 months now, we are into a war. I have a very simple question to you. What do you feel? And please answer immediately. What do you feel? How does war impact stock markets? Negatively or positively? What do you would say? I'll pause for a moment here. How does wars impact stock markets?
Generally, it should affect negatively, but it seems at this moment it is affecting like not sure sideways thing.
Are we worried that there is a war going on as an in the stock market investor? You can say yes or no, right? We are in the middle of the war. Are you worried as a stock investor that war is going on in the world? What you will say? No, that's great.
We have started getting response. Someone saying positive, someone is saying negative. So negatively to the market, positive for the investors.
Now, Yogesh, what we have observed is, I started traveling now since March, although I was operating from home for the last 2 years. And I've been to several places in the last 1.5 months, been to larger cities. I've been to Pune also 2 days back. I've been to Mumbai, I've been to Ahmedabad, I've been to Kolkata, and could connect with people in person. And I asked the same question there as well. That what do you feel that how does war impact stock markets? So most of us have the view that wars damages economy, war damages financial markets, war is something that destroys everything, and war should not happen, right? So it impacts markets negatively. But if you look at history, Yogesh, whenever war has happened, we have a history of index movement since 1895. Dow is there with us. And US is the country which has fought the most war in the world. you will surprised to know that in most of the, not most of the war, let me say all wars, markets not only have recovered the initial fall, they have given us the positive returns before the war ends. And this is something very interesting, right? Almost all war leads to inflation, right? And inflation is so high during the war that even inventories gives return to the businessman. Normally for inventories, businessmen have to spend money to maintain inventories in godowns, right? Inventories are expensive, right? They add to your cost, but wars, even inventories gives you return. And that's the result that usually many of the businesses, very few businesses report losses. Most of the businesses reports higher profits during and after the war, right? And this is what the stock markets behave. What I want to say is very simple. This is called thinking fast and thinking slow, right? Our brain has two kinds of reactions. Reactions, we call it knee-jerk reaction, immediate reactions, which is an emotional reaction. And then there is a reaction which is based on the assessment of various challenges we face during the period. And then we try to find the solution. That is called thinking slow, right? And two reactions are always different reactions. And this is what, friends, we will try to cover it. Yogesh, I'll share a screen to take this through with the help of a few slides. So that we can give the evidence also what we are talking. Is the slide visible, Yogesh?
Yeah, it's visible, sir.
That's great. Thank you. Friends, very simple. Let me see in chat. I received some replies: negative in short term and positive in long term. That's great. Good to know that. Vijay, that's great. And that's negative for the short term. It happens due to traders, and positive for the long term for investors. So what's interesting, Vijay, with your answer, let me elaborate that. If you want to enjoy the session, if you want to take some positive takeaways from the session, you have to ask yourself one simple question: who are you? Are you a trader or you are an investor? Right? Traders have a different reaction and investors have a different reaction. Without understanding two things in the markets, Yogesh, and that is short term and long term, and who am I, trader or investor, it's difficult to connect dots, right? We always should understand two concepts: what is short term and what is long term, right? Rarely people define these two things. And then who am I? Am I a trader or an investor? Now, this is something very sad chart in front of you. This is a chart from MFI. As you can see here, focus on the blue columns. Ignore the green columns because we are here to talk equities. So these are equity investors, and we all will accept that equity is a long-term asset class, right? Even then, Yogesh, you can see here, those who open equity investments, start doing equity investments in mutual funds, 6.8% withdraw within an investment of 1 month. They close their account, 7%, close to 7%, close to 10% close their account within 1 and 3 months, 15% in 3 to 6 months, and 18.4% in 6 to 12 months. If you add all four, close to 50% people take their money out from equity mutual funds within a year. Can they create wealth? Right? So why at all these investors have invested in equity mutual funds? Something very surprises me, right? And why it happens? It happens for a very simple reason that two facts which we need to understand. Friends, whenever we invest money in equities, there is something very interesting. When you invest money, when you write the check to invest in equity mutual funds, please tell me what is there in behind of your mind? What is the frame of your mind? What do you believe, that markets will rise or markets will fall? Whenever you write check to invest in equities, now you strongly feel that markets will rise. You're optimistic that markets will rise. You never believe that markets will fall. If you believe that markets will fall, you will not write checks, isn't it? Right?
Right, sir.
This is what in the back of our mind. But we all know that markets can fall anytime. Now, there are two different things. When you write check, you believe that markets will rise. At the same time, you believe that markets can fall anytime. And when markets fall, it hurts your ego, because at the time of investing, you have your assessment was that markets will rise. And there lies the challenges. Yogesh, let me share with you something very interesting. 93% of investors which I have surveyed, I survey at my end also. And I ask people, whenever you buy stocks directly in the market, what happens next day? Prices rise or fall? let me ask this question, friends here also.
Yeah.
So when you buy stocks in the market, what usually happens? Next day, the price falls or rises.
Most of the time falls.
Most of the time falls. And that leads us to a very challenging situation. We buy thinking that markets will rise, but the price falls.
Absolutely right.
Then as a human being, how will we react? And that hurts our ego. Am I stupid? Have I done the wrong assessment? I was thinking that stock price will rise and it has fallen next day. And that's why 50% withdrawal within a year, Yogesh. See, I have seen in my life almost now closing to 3 decades. I have a data to prove it. I am from HDFC Mutual Fund, Yogesh, and there is one scheme which has covered 27 years. You know, there are only 2% investors in all these 27 years, which has remained invested for 10 years. Forget about 27 years. There are only 2% investors, those who remain investors for a period of 10 years. And these are the people, those who have made wealth, right? So why that has not happened? That has not happened because we give too much of importance to news. Right? Too much of importance to news. Too much of importance to what's happening in contemporary times. We watch TV a lot, right? I strongly believe personally that watching TV on a daily basis is injurious to your wealth, right? One should not do that. That will reduce you to a trader. That will not allow to function you as an investor, right? Now look at this in the last 10, 12 years, what has happened. We have started with subprime crisis, markets fallen to 8,000. Then we have very high fiscal deficit, very high current account deficit that has resulted into a very high inflation, interest rates in India. Inflation was as high as 10, 11%, and interest rates, bond yields were as high as 9.75%, if you remember in 2011, right? And that has resulted into a steep rupee depreciation. Rupee lost 20% in 2013, and India was a fragile 5, right? That was on the fear of tapering, right? As soon as we overcome tapering, there was a fear of Brexit, and again, market lost 25%. Then we have demonetization, then we have GST, and that COVID, we have a fall of 24% in economy and 34%, 35% fall in markets. And now Russia-Ukraine war. But look at what has happened to the market for a peaceful investor. Markets have grown for 8,000 to 57,000. So what makes us to respond to these headlines? What makes us jittery investors? What's prevent us from functioning as a long-term investor? This we'll try to understand. I want each one of your participation in this small exercise, friends. Look at here, you will see 2 series, right? There is a series blue, there is a series red. You will see 2 alphabets there, G and R. So before you look at these alphabets, let me give you 2 information. The information is that occurrence is random. There is no pattern in this occurrence, right? It's a random occurrence. And what you have to do is you have to look at the series below, and you have to, from where the dot starts now, you have to tell me which is the next alphabet, right? So first we'll focus series 1. So there is triple G, then R, then triple G, then double R, then triple G, then triple R, and then 4 times G. What is the next alphabet? You have to tell me.
4 times R.
You can write in the chat box. Which one is the next alphabet? Okay, R.
4 times
Right. R. Right, 4 times R. That's great. R. Okay. That's great. Thank you. So now, friends, focus on the series 2. In series 2, you can see there is a triple G, then R, then triple G, then double R, then 4 times G, and then R. Which is the next alphabet?
Now 3 times R.
3 times R. Okay. Okay. Pradnya Joshi. G. Okay. That's great. Vijay. Okay. So mostly R, and then I received G from 2 guys, right? Okay. Very interesting. Can I ask Vijay and Pradnya what made them to answer G? They are on mute, Yogesh ji.
We'll unmute them. We'll unmute them.
Okay, great.
Yeah.
Please unmute them.
They can
After
unmute also.
Yeah. So after looking at for a longer growth, when there is a dip, there is a likely growth positivity as well.
Mhm.
Okay. Because market is still moving unless
No, there is no market here. There is no market
okay.
here. No?
So there is a likely G.
Why G? Why you responded G?
Yeah, because most of the time occurrence seems to be on G's. Yeah.
That's great. I salute you. Pragnya, what's your reason? Now, Yogesh, this was the human touch, the ultimate human test. Yogesh, you remember I cautioned you that I'm giving you two information. What were the two information? Number one, the series is random. There is no pattern here.
Absolutely right.
Even then, most of us found pattern, right? And the answer is they're not even given me R. They given me three R's and 4 R's. Right. And then I said that probability of G is higher.
Yes.
It's written there.
I was not able to unmute. Okay, so my I think it is more on perspective than the series. So I had written G because I expect growth always. So maybe that is the reason I've written G.
Okay, that's great. So look at Yogesh, what's happening as human beings now. The biggest challenge in front of us is that we always see pattern. When I cautioned you there is no pattern, even then we found pattern.
Absolutely right.
So when we see patterns, now Yogesh, what happens in a falling market, we'll be afraid to invest because markets will keep falling. In the rising markets, will tend to invest because markets will keep rising. And that's why 90% of equity mutual funds folios are created in rising markets. It's counterintuitive, but it happens, right? And this is what we have to learn, right? Now, doesn't we know this? We know this, but knowledge doesn't help you to do right investments. It's the habit which helps you to do right investments. In stock market investing, it doesn't matter what you know, what matters is how you behave, right? And that's why we strongly feel that investing is a psychological challenge. Investing is not a financial challenge. I'll share with you something very interesting, right? In US, what happens, friends, that whenever the year starts now, the last Thursday of January, last Thursday of every January, the president of the US addresses countrymen and conveys them a message. What is the state of the union? What is the state of the country? Economic state of the country particularly, right? It comes an address and gives status of the economic status to the countrymen. Now look at, this is addressed by Clinton in January 27, 2000, right? And what he said to his countrymen: never before has our nation enjoyed at once so much prosperity and social progress, with so little internal crisis and so few external threats. Look at this, what Clinton is saying to his countrymen. We begin the new century with over 20 million new jobs, the fastest economic growth in more than 30 years, the lowest unemployment rate in 30 years, the lowest poverty rates in 20 years, the lowest African American Hispanic unemployment rates on record. And this is what Clinton has conveyed to his countrymen. January 27, 2000. Now come to Barack Obama. Thursday, January 27, 2010. And what he conveyed to his countrymen. 1 year ago, I took office amid 2 wars, an economy rocked by a severe recession, a financial system on the verge of collapse, and a government deeply in debt. Right? The devastation remains. 1 in 10 Americans still cannot find work. Many businesses have shuttered. Home values have declined. The small towns and rural communities have been hit especially hard. And for those who had already known poverty, life has become much harder. Now look at the 2 messages, Yogesh, right? But look at the stock markets after these messages. After President Bill Clinton's message, the market had a fall for continuous 3 years negative returns. And after the address of Barack Obama, market has positive returns for next 4 years. What does it mean, Yogesh? It means that please accept, even after COVID, when COVID, everyone was saying that market will fall, market had a rise, and we know what kind of a rise markets had. For God's sake, accept one, learn this lesson. We must learn. None in the world has an idea what the markets will do in short term. Right?
I think we lost him.
When you fear that markets will not be good, when you fear that economy will not good, you try to go to safe havens. What are safe havens? Safe havens are assets which gains in value when economy does not do good. So when you fear that economy will not do good, when you fear that markets will not do good, you tend to buy gold and tend to remain in dollar denominated investments. And every year in the world, people buy dollars or dollar denominated investments, they gain in value. So at the start of Russia-Ukraine war on 23rd of February, gold price was 1905. And within next 10 days, gold price had a rise of almost $150 and scaled up to 2052. But soon after that, gold price started falling. What does it mean? That although the war is going on, the markets have ignored the war. And this is what I want to convey to you, friends. Right? Look, this is the same thing happened with the dollar. Dollar had a rise from 96 to 99. And again, it has fallen to 97. Now, many of you will say that from 97, it has again gone back to 100. It is not due to war. It is due to tapering. It is due to stopping of bond purchase program by Fed. It's due to rise in interest rates by Fed. It's not due to the Russia-Ukraine war. Similarly, near home, if you look at the Indian crude prices, just after 23rd of February, crude prices started rising from 98 to 127. But again, they have fallen back to somewhere close to 100 or below 100. Nearer home, you can see how the stock markets have responded initially, and then they have ignored and they have recovered whatever losses happened due to Russia-Ukraine war. And the war is still going on. The war is still going on. Let's keep in mind that things, right? So what's interesting thing we have to notice is that giving importance too much, giving premium too much to the news in the short-term basis or a daily basis doesn't help you. Now that gives rise to something very important discussion in investing is, who are we? Are we Homo sapiens or are we Homo economicus? What is Homo economicus? Till 2002, Yogesh, the science of economics, if you call it science, some countries call it science. India doesn't call it science. India says it's a social science, right? So economics says that human beings are rational creatures. Human beings are logical creatures. Human beings are intelligent creatures, and they always act in their interest. They always take right decision. This is what economics says, right? But there is an economist called Daniel Kahneman. He's more psychologist than economist. He said, no, humans are not rational. Humans are emotional. They always are in search of avoiding pain and seeking pleasure. They do nothing else in life. Whatever they do in life is just to avoid pain and seek pleasure. For the normal, not everyone, for normal people, right? He says that. He says that each one of us know that we want good health. Each one of us strongly believes that attaining good health, you require to do regular exercise. Each one of us have a knowledge that morning walk is the best exercise. So you have a knowledge that you need good health. You have a knowledge that regular exercise is must. You have a knowledge that morning walk is the best exercise. Then why 99% of human beings don't go for morning walk? Because they enjoy sleeping in the morning. They seek pleasure, the short-term pleasure, and avoid the long-term pleasure, right? If they will go for the morning walk, they will attain the long-term pleasure. So my question is very simple. When you cannot take right decision for health, how you can take right decision for wealth? And that's the challenge. So after 2002, no more economics says that humans are rational. Now they say that humans are emotional. And this is called behavioral finance. Before that, there was economics, but after 2002, there is new economics called behavioral economics, right? So you have to look at yourself, right? Your portfolio performance is not portfolio performance, it's your performance. It's not portfolio's performance, right? If it has been Yogesh portfolio's performance, then every portfolio's performance would have been same,
Absolutely right.
Every individual's portfolio is in market, but every individual's portfolio performance is different.
Absolutely.
So it's your performance. It's not the portfolio's performance. And this is what individual has to accept. So the moment individual accepts that, now he becomes a successful, he or she becomes a successful investor, right? Charlie Munger used to say that investing is not easy. And if somebody feels that investing is easy, it's stupid, right? And I love particularly J.K. Gilbert's thing. He says that you cannot learn investing. It's so difficult because there is nothing reliable here. It changes with every individual. Every philosophy, every rule, every principle changes with every individual. If there were one, there would have been courses how to create wealth. Is there any course how to create wealth? There is no course in this world how to create wealth, right? And everybody would have created wealth. You cannot do it without understanding yourself and your behavior. So what does it mean? It means that investing is something which doesn't test your IQ. Investing is something which doesn't need your knowledge. Investing is something which tests your character, right? How you respond, how to react under various circumstances. And circumstances changes. The environment changes. The market changes, right? And this is how we will try to understand today's little 2 or 3 things, Yogesh, which will help us to become a good investor. This is something very important to understand. Just I'm sharing with you a journey of one stock. It's a Nifty stock, one of the most successful Nifty stock. It is such a successful Nifty stock, Yogesh Bhai, that it's kept gaining weightage in Nifty 50. The weight started from somewhere 1% and it gained up to 10% weight in the Nifty, right? It started listed on 26th May 1995 at rupees 40. The first trade in this share was at rupees 40, right? And after 25 years, 26 years, on 25 May 21, almost 8-10 months back, the price of the share was 1509. In between these 25 years, the stock has given you bonuses. So if you have bought 100 shares in 1995, they are today 1000 shares. So if I multiply 1000 with the price of 1509, the value is 15 lakhs. What does it mean? A person who has bought 100 shares in 95 has costed him 4,000 rupees. Your 4,000 rupees has grown to 15 lakhs of rupees. But this is not something I want to convey to you. What I want to convey to you, in these 25 years, Yogesh Bhai, there were 6123 trading days, 6,123 trading days. Out of the 6123 trading days, in 3066 trading days, the price of this stock had a fall. So 50% chances are there that when you buy a stock, next day price will fall, right?
Correct.
And out of 6123 trading days, this is more important, 5,693 trading days price is lower than previous high.
Oh,
Lower than
previous highs.
So if a person has bought this share, 93% chances are there that person has lost money after buying. And this stock has created 15 lakhs of rupees from 4,000. If best company can deliver that kind of performance, that kind of volatility, what will happen to other companies? Just think about this.
Interesting data.
Right? Just think about this. And that's why we should not watch market on a daily basis. The moment you start looking markets daily basis, you cannot create wealth. And I will recall the wisdom of Warren Buffett. He says that the day I buy stock, I start believing that the market is closed for the stock for next 10 years. I don't revisit to see the price, what happened next day, next month, and next year.
True.
And this is what, friends, we have to understand. From where to get that character that we can ignore this kind of volatility. And this has happened with the best of the company Nifty 50. Forget about what would have happened to the other stocks. So what's the challenge, Yogesh Bhai? The challenge is the moment you become an equity investor, you will have bouts of uncertainty, lots of confusion. You have to go through short-term losses. In between, you may have some good surprises also. But believe me, the biggest challenge is lots and lots of boredom. This is called consolidation of your equity share or consolidation of the markets. The entire 22 will be like that only. It will be full of boredom, and that will give you anxiety. Oh, my investment is not going anywhere. My investment is not going anywhere. And that anxiety will give you fear and lots of discomfort. And you remember what Daniel Kahneman says, humans avoid pain. And discomfort is nothing but pain. So what is the answer to avoid pain? Come out in difficult times. And that's why 51% people came out within a year after investing, as per MFI records. Right? These overcoming this emotion, experiencing this emotion, feeling this emotion is the price you pay for 16% CAGR return. This is the price you pay. Are you ready to pay this price? You have to pay this price. Now, lastly, I want to share one thing. There's a fund manager, Yogesh Bhai, his name is Lee Freeman. He has written a book, SHOR, right? Now, he is not a fund manager. He is a fund manager of funds. What does it mean? He doesn't invest directly in the markets. He invests in fund managers. So this person has invested with 75 fund managers for 20 years. With 75 fund managers across globe for 20 years. And what he says that there are 5 kinds of fund managers. Those who hold losses eternally for a very long period of time, they hold losses. They don't cut losses. There are fund managers who will cut losses. There are fund managers who are bargain hunting. Whenever markets will fall, they will surely buy. There are fund managers who will book profits. And there are fund managers who will hold performing equities for a very long period of time. And he says that the true wealth is created by only those fund managers, those who have waited for a very, very long time for very book profits. And they have always cut losses and never book profits. So what does it mean? It means that they never allow losses to rise and they allow profits to keep on rising. So what's benefit you get out of it, UAG? Losses are always finite. They are always limited. Profits are always infinite. Sky is the limit. It can go anywhere, right? So this is what Lee Freeman's message is, and that message I want to give to our friends here. It's investing is not really about what you know, it's about how you behave, right? And the same markets can have different experiences. Now, how we behave, that's something we need to understand. And that we'll understand with the simple examples, Yogesh. The biggest problem with human beings is this. Humans doesn't know, don't laugh at me what I'm going to say next. Human doesn't know what they want. You have to spend considerable time talking to self, not talking to others, talking to self and finding out what is that ultimate thing I want in my life? What is that ultimate thing I want from my money? What is that ultimate thing I want from my savings? What I'm in search for, right? I'll give you an example from a very simple thing. Number one is humans are contextual, right? Now assume that this cheetah is chasing antelope, a springbok, right? And the next moment, what will happen? The next moment, what will happen? The cheetah will kill the springbok, right? Whom your sympathies are with whom you sympathize here in this scene? Who is the weak here?
Antelope.
Right? Who will get your support? Always springbok. Now, oh, the poor chap will be killed by this cheetah, right? Now, assume that if you have your sympathies, you empathize with the fate of this springbok, this deer. You pray God, oh pray please, oh God, please save this deer from clutches of this cheetah. and assume that God listens to your prayer. And cheetah fails to catch this prey. Cheetah again fails to catch this prey. Cheetah third time fails to catch this prey. Cheetah got exhausted, could not get free that day, and cubs of this cheetah die of starvation. You get this news next day, right? Now your sympathies are with whom?
Cheetah.
Cheetah.
Don't you see your behavior has changed?
Absolutely right.
Your sentiments are contextual.
Correct.
Context changes, your decision changes,
Indeed.
right? Our market changes every day. So information will keep on changing now. This is one set of information that cheetah is killing springbok. And the second set of information, it failed to kill the springbok and kids died. That's the second information. And with second information, your views changes.
True.
So one psychologist, Herbert Simon, says, wonderful thing, Yogesh, a lot of information creates poverty of attention. Information doesn't create wealth. Your attention creates wealth.
It's well.
But you have to spend attention to get information. Your attention is limited. The information in the world is unlimited. So what you have to ensure that your limited attention is spent on right information.
Correct.
How you will do that? Information will keep trickling in a minute per minute. Now you have mobile in your pocket, right? And that's why the holding period in equities have fallen in US to just 7 months, which used to be 9 years, 30 years ago. The holding period of equities. And that's why Dalbar Associates, the firm which chases the investor sentiments, investor returns, says that most Americans don't earn average returns. They earn below average returns. Most Americans, I'm talking of Americans, forget about Indians. Those who have a stock investing experience of almost 1,000 years. Right? Now, this is a very interesting research a psychologist has done, who has written a book, Nudge. Right, a very interesting book. अगर आप में से किसी को पढ़ना है तो पढ़िए. वो क्या कहते हैं? उन्होंने he has done this experiment with a cinema hall in Europe. In interval, now what they offer to the audience, those cinema goers, that you can buy one burger in €1, which has a single cheeseburger, and then at €2 you can buy double cheeseburger, right? And they offered this, right? So what they observed, that 50% bought single cheeseburger and 50% bought double cheeseburger. Now psychologists advised him, I will make you that most people will buy double cheeseburger. Okay. The vendor said, what you will do? Suggest me what I have to do to increase my sale of double cheeseburger. And psychologists advised him, you do one thing, from the third day, you offer this. The next day, what he did, the vendor, he offered now this €1 single cheeseburger, double cheeseburger €2, and triple cheeseburger at €3. Now there are three things. People went confused, and that day 60% people bought double cheeseburger, 30% bought single cheeseburger, and 10% bought triple cheeseburger. And vendor could increase its sales. Now why it has happened? Please tell me. People are not sure which burger they want to buy. Here also people are not sure which burger to buy. So if you increase choices, the shopkeeper will be able to sell what shopkeeper wants to sell. So I challenge you, Yogesh, one thing, and please listen to me. I challenge you one thing. Most of us buy jeans, the choice of shopkeeper, not our choice.
Absolutely right.
When we go to the market and buy jeans or garments or shirts, now we end up buying of their choice, not of our choice. They will throw us so many choices in front of us that we will confuse, and we will end up buying what the person wants to sell to us. Right? So what does it mean? It means that human doesn't know what they want. Right? It's called context. Our context changes. Our preference changes. Similarly, in stock investing, in equity investing, our preference changes. And usually preference changes when? It changes when the reversal takes place, when there is a conflict between short term and the long term. If I will throw a picture to you entirely of long term, in long term, you always opt for larger rewards. They are more attractive. Larger rewards are most attractive in longer terms. But if I make the term shorter, then human beings tend to opt for a reward which is closer, not larger, right? When I came to know about this human behavior, I did experiment with my son. At that point of time, my son was 5 years old. I asked my son, "Beta, do you love chocolates?" He says, "Yes, Papa, I love chocolates." So if you love chocolates, tell me one thing, you want more or less? He laughs at me. "What is it, Papa? I love chocolates, I want more." Then immediately I gave him offer. "Okay, beta, I will give you 3 chocolates tomorrow, but I'll give you 2 chocolates today. What you will take?" What was his what he advised me? What was his statement? "I love chocolates. I want more chocolates." So when I told him that I'll give you 3 tomorrow and I'll give you 2 today, he opted for lesser one because they were today. Right? So what's happening here? Your preference changes. Your preference changes. So what happens in market now, every day, return on your portfolio prospects keep changing. Right? And the day you invest, you open your SIP account, the day you start investing account, you think of 20 years. But within 2 weeks, you start thinking for next week. And when you start thinking for next week, the prospects which are closer makes you feel those options which are closer to you are more attractive than what decision you have taken 2 weeks back. And you tend to reverse your decision. And that's why 51% of people have withdrawn money within 1 year. So remember one thing always, your preferences are usually contextual, and context is made by the information flow. Information flow keep changing, context keep changing, and that makes you volatile. It's not that markets are volatile, it is investors who are volatile, and the result is volatile markets. Markets are never volatile. They are the investors in the markets who are volatile. And this is what we need to understand in investing. Right? So we often don't know what we want until we see it in some context. Right? So introducing an inferior decoy, this is what shopkeepers do. Right? So whenever you will go and buy specs now, so what shopkeeper will do, they will show you a spec costing 5,000 rupees. Right? And they will read your expressions. And they will read your expressions and believe that, oh, you are finding 5,000 rupees specs bit expensive. Then they will show you a spec of rupees 1,000. And that rupees 1,000 specs will be the look also will not be good. The quality also will not be good. Then you will say quality is not good. Then he will show you the third spec, which will cost 7,000 rupees of superior quality. But you find that the quality of 7,000 specs is similar to the quality of 5,000 specs. And you will end up buying 5,000 specs. Right? So this is how shopkeepers do. So what they will do, introduce an inferior decoy, and that will create a simple comparison of one option and thereby make superior. Don't you feel that in portfolios, it always keeps on happening because there are so many equity mutual funds, right? And every day, the performance of various equity mutual funds will keep changing. And every day that will put challenges to you, whether they are the right kind of schemes in my portfolio, right? And that gives you a sleepless nights. So lastly, this is the experiment of Harvard Business School of MBA students, right? I just rephrase that so that we can understand how human emotions work. There was a group of students who were asked that we offer you a job. It's a campus recruitment, right? In colleges, what happens? Companies come and they offer jobs to them. So they offer jobs to the MBA students, final year MBA students. What was the offer? The offer was option one. They will work at a company where the salary is rupees 35,000. That was $35,000. I made it rupees 35,000. So there was a company which offered them a salary of rupees 35,000. Now there was a company B where the salary offered to them was 33,000. Both are similar companies. They are from the same sector. They have the same reputation. So all other things are same. So psychologists ask the MBA students, which company you will join, offering you $35,000 salary or $33,000 salary. Most of them, 90% of students, 92% of students opted for option one, company A. We will go with company A. Why we will go with company A? Because salary in company A is higher than salary in company B, right? Next day, what they have done with another set of students, right? Next day, with another set of students, what they have done? Option 1, those who will opt for company A, they will be given 35,000 salary, but all other batchmates will give 38,000. So in a one-to-one interview, what they were told, so we are going to select 10 students from your class, you will get 35,000, others will get 38,000. But in company B, you will get 33,000, your other friends will get 30,000. Which company will opt? And most students, what they opted, option 2. They were ready to get less salary, but they wanted to ensure that my salary should be more than others.
Correct.
What does it mean? You always look for equity mutual funds relative performance, not absolute performance. Arey Baba, your portfolio was generating 8% for you. Advisor has brought a portfolio to you which is giving 10%, and after receiving 10%, you talk to your friend whose portfolio is 11%. Now you want that portfolio. You're not happy with 10%. Right? So what you want? You don't want good performance. You don't want good returns. You want returns which are more than others. And that makes you to change your portfolios quite often. What the message is, please try to find out what you want. Humans doesn't know, they want more or they want less. Humans know only one thing, they want more than their brothers, more than their sisters, more than their friends, and more than their neighbors. Please, in investing, do not make them your benchmark. Your benchmark should be your past return. What does it mean? It means that if my portfolio has generated 10% return in last 15 years, I'll ensure that my portfolio generates 12% in next 15 years. That's the benchmarking. This should not be the benchmarking that what neighbor is getting, what friend is getting. The moment you do it, you fall in a trap and you take wrong decisions. So this is what I just wanted to convey. Yogesh bhai, this is very simple thing. Volatility is your friend. As the time increases, volatility falls. Minimum returns increases, maximum return falls. Nothing very great in this chart. I will not talk much on this chart. This chart is shown by every mutual fund. Every speaker uses this chart. The chart says that stock markets tend to be more volatile in short term and they tend to be stabilized in the longer term duration. If you invest beyond 10 years and beyond 10 years, chances of negative returns are 0 and chances of good returns is very high and standard deviation is very low. Right? And what is the important thing? Let me suggest you, Yogesh, from my personal experience. When I got married in 1999, very first few months went off very well. There was no issues at all and we were very happy. But one fine day, what happened, Yogesh, I received very bad news, one of the saddest news of my life. One of my very close friend died in an accident in Mumbai. And that went into my mind that my wife is a house. Those days, my wife was not working. We were newly married of 7 months only. She was housewife. If that fate happens to me, if I have a similar fate, who will take care of my wife, right? I should do a right insurance. Those times, right insurance was not there in India. Only endowment insurance was there. But I was so lucky that term insurance were introduced by private insurance companies. Insurance was deregularized in late 90s, and one private company introduced term insurance. And I bought it. Whatever price the company was offering, I bought it. After my marriage, I ensured that my wife will always fill the form so that she knows what I'm doing, right? So she was filling the form and she asked me, what is this? Why are you filling this form? I told her that if something happens to me, if I die due to any disease or accidentally I die, you will get the sum assured, you will get that kind of amount, interest on that amount will be equal to my salary, and you will have no financial troubles in the rest of your life. So that's why I'm doing this insurance. She will use the word investment. Why are you doing this investment? Right? Most Indians call insurance investment. Right? So she also said that why are you doing this investment? Just after a week that, those days I was working in UTI. UTI introduced SIPs, systematic investment plans. So internet banking was not there. Direct debit was not there. So we used to submit 12 post-dated checks to do SIPs. So I brought the form of SIP, and again I requested my wife to fill the form, and she was filling the form, and then I asked her to fill 12 checks, and she was surprised. How come whatever investments you have done in the past, there used to be one form and one check? How come today 12 checks today? I told her this is a different concept wherein every month we will save and every month directly it will be invested in a scheme. Then she asked me a simple question: why are you doing this investment? So I asked her why we have done last week insurance. She said that if something happens to you and if you die early. So I told her, I am doing this investment if I don't die early, if I live longer. See, there are two probabilities in life now. Either I can die early or I can live longer to 90 years. If I live long, then also I need money. If I die young, then also I need money. I ensure to plug both the possibilities. I have to ensure to face both the probabilities. And this is what in stock markets we have to do, Yogesh. When you do investment, you strongly feel that markets will rise. And that's why you write the check. But at the same time, you write down in your diary, what if markets falls, what I will do? Are you prepared for that fall? Prepare yourself for that fall. Don't predict for the markets what will happen next day. Prepare yourself for that fall. The way I have prepared, even if I die young or if I live a longer life, what my portfolio should have. Similarly, in your portfolios also, you have to ensure, you have to prepare yourself if markets behave just contrary to what you have to believe in yourself that market should behave accordingly. If you do that, now you'll be able to control your emotions. You will be at peace. To attain prosperity, one has to be peaceful. So don't predict markets. Don't forecast markets. None can do in this world in short term. You have to prepare yourself. This is what I wanted to discuss, Yogesh. Three things in the last: have faith in the growth of India. And there are several things which will help India to grow. I don't want to talk in any one of them. I want to share only one thing. And understand this, what's happening in my family, and you will be able to understand this from your families as well, because that's the biggest reason that why India will grow. Yogesh, if you go through the data given by IMF is a firm which forecasts economic trends for next few years. So as per IMF forecast, India's GDP will double in next 5 years, forecast one. And forecast second is India will be the fastest growing economy for next few years. Now, what's the reason? There are several reasons to it, but let me share with you the biggest reason. What's going to happen in next 5 years? 1960s, I remember my history of my family. My father was the sole breadwinner, earning person in my family. He had 5 siblings and parents dependent on him. So 1 earning, 7 dependent, right? Late 90s, mid 90s, when I started working, all my father's siblings went to their own family, settled and all. Our family was of 5, we 3 brothers and sisters, mother and father. In 5 people, we 2 are working. Now look at the equation now. 7 dependent, 1 working. In mid 90s, 5 dependent, 2 working. Right? In the first decade of current century, in my family, there were 5 members, 3 working. Look at the equation, right? Now in my family, we have 4, 2 kids, my husband and wife. I've lost my parents. My wife is working, I am working, and my elder son started working. And a family of 4, 3 working. Within 3 years, all 4 of us will be working. First time in the history of my family. First time, again, I repeat this. First time in the history of my family, never in the history of my family, never where everyone was working. In next 5 years, each and every member of my family member will be working. And Yogesh, please remember, your earning is others' expenses. And if every member of my family will earn, what kind of spending we will do? And that adds to the GDP of India.
Well said.
And lastly, this is among all the top 20 countries in the world. I repeat, among all the 20 top countries in the world, India is the only country where this equation is changing positively. All other 19 countries, this equation is changing negatively. So next 5-10 years offers you the best years to create wealth. With these words, I take leave and present myself of any questions. Thank you very much for the opportunity. Jai Hind.
Thank you so much, sir. It was a really eye-opener. The perspective, the belief, the psychology, the investor mindset. So you have touched so many dynamics of today's presentation. I'm sure our participants have enjoyed today's sessions and carried some learnings from today's session. So now we are open for Q&A. So we'll allow all the participants, they can unmute themselves and then I can ask any questions if they have.
Yeah, Mr. Balasubramanian is right. It's a framing, hyperbolic discounting and framing effects, sir. You're right. You're a student of psychology.
I
Yes,
have one
Mrs.
question.
Yeah.
Mr. Subramanian, you have to unmute yourself. Mr.
I
Balasubramanian.
teach critical thinking for a living. I'm a former CFO, and I spend all my time understanding cognitive biases.
Oh, great. Nice to know that, sir. Thank you for being with us today.
Yeah, it's a pleasure. I have a question because maybe
Yes,
it's not my turn, but you said that yes, our GDP will double. Do you, in your wisdom, which sectors you think will have a higher growth rate than other sectors? Do you think financial services, insurance, banking?
Sir, my understanding is quite simple in this. Assume that I'm a school teacher, right? And I have 10 students and I have to give a result where all 10 students pass. That is 100%, right? My result. And what I observed that in half-yearly examination, out of 10, 5 have failed and 5 have passed. And now in annual examination, I have to ensure that my result is 100%. So on whom I will focus to achieve that target, that I should have a 100% achievement. So I have to work hard on these 5 students, those who have failed, right? Now, in our GDP, Nifty 50 represent our GDP, right? In Nifty 50, there are 10 sectors. Out of these 10 sectors, only 4 sectors have given you positive profit growth rate in last 5 years. Rest of the 6 sectors could not produce you those kind of results. Now, what has happened in the last 5 years? In last 5 years, by the end of 2016, the quarterly GDP growth rate of India used to be 8.25%, which has fallen to 4% now. Our GDP growth rate last quarter is 5%, and that is post-COVID, sir, right? When we are recovery phase. That last quarter, just pre-COVID, our GDP growth rate was 3%. What does it mean? That these 4 sectors are giving their contribution for the growth of India. The rest of the 6 sectors are not giving. And those rest of the 6 sectors are finance number 1, industrials number 2, capex number 3, infra number 4, commodities number 5, metals number 6. Metals have started giving returns. Till these sectors doesn't start performing, our GDP growth rate will not come back. So what government has to do? Government is doing those kind of reforms wherein it is being ensured that these 6 sectors perform. Then only we'll be able to go back to GDP growth rate of 8%. This is in specific for India. Now, as an investor, I should not only share what's happening in India, I should share what's happening in the rest of the world. See, what are the investments which gives you a highest possible return? The businesses which gives you highest possible return should have 2 characters. Number 1, their business should keep on rising. And business can keep on rising with one condition only: when the product which they produce, the solution which they give, that solution, the price of that solution keeps falling. If any business meet these 2 conditions, they give you multi-bagger returns. So there are only 5 sectors which are this. What are these 5 sectors, sir? Artificial intelligence, blockchain, robotics, renewable energy, particularly solar roof, right? And one more thing, I'm not able to recollect now. As it comes, I'll tell you. These are the 5 sectors wherein the top line is growing, the bottom line is growing. Why? Because solutions they offer is becoming cheaper and cheaper. But unfortunately, all these 5 sectors, you have to take exposure outside India also. And that I strongly believe that your advisors must be advising you if your portfolio is beyond some size.
As somebody from the IT industry, I agree.
Yes, Yogesh.
Yeah, I think if there is any further question, we can take offline. We are just 6 minutes over to the time, so it's already 11:36. So we could conclude the call today. Thank you so much, sir, for joining us and blessing this event today. We are looking forward for more such events from you, sir. Thank you so much.
Thank you for the opportunity. Thank you, Yogesh. Thank you, Beg. Thank you. Namaskar.
Thank you so much. Thank you so much.
All participants may request to leave.